On this episode, I interviewed Cliff Ford with Skyview Realty, and he specializes in the sale of apartment buildings. He's sold over 250 buildings throughout his career. He's been in the industry, he mentioned, for about 18 years now. And on this episode, we talked about some of the challenges that people are facing in the apartment building space. We're talking about 30, 40 plus unit buildings, some of the strategies that they've had to apply into their own portfolios to stabilize things. So they bought a couple buildings back in 2020, 2021, and he shared how they were able to convert some of the kind of useless space in the building, like these little kind of storage rooms, into office space to create that extra income and to help stabilize the cash flow. So I think there's a lot of cool things in here that we're going to touch on. We talked a little bit about VTBs and what he's seeing in the market when it comes to that. You guys are going to enjoy this if you are interested in commercial multifamily. And if you do, make sure to leave us a review on the Apple Podcast platform, and make sure to share this with a friend or family member who wants to learn more about apartment buildings. Your support's truly appreciated. Thank you for all the people that have been listening for all these years. And the last thing, if you want to connect with me to talk about investing in multi-units, I'm more than happy to have a chat with you. You can go to welloff.ca and book a call there. Enjoy the episode. I'm here with Cliff Ford. This is the second time you've been on the show. The first time was about 3 years ago. So
that's right.
We were both you and I were kind of listening back to the conversation separately, obviously, but we were talking about how at that time the market was on fire.
Absolutely.
These big buildings were getting multiple offers left, right, and center. Yeah. And obviously, now times have changed quite a bit. So
yeah, the market has cooled a bit. Yes.
Yeah. So why don't we start off? A little bit, just kind of tell us what you're seeing in the market now with these larger apartment buildings. Just maybe start with that.
For sure. Yeah. So in 2021, we saw sort of a gold rush with multi-residential. Everything was brought to market, was selling. There was such fervor out there for people to find these buildings. And then in 2022, we saw us starting to slow down as interest rates started to climb, just because it made it not impossible, but difficult to finance the properties at the values that the market was currently paying for these types of properties. And so we saw a little bit of a cooling of not only the amount of listings that were coming to market and the amount of buildings that were being sold, but the amount of people who were interested in it. And so, in 2021, we would have 14, 15 offers on any building we brought to market. Now we might get 2 or 3 solid, good offers, and still able to sell the buildings, but you're not finding, you're getting a huge wave of interest. You're getting just the right people who might be interested in that particular property.
Are you getting competing offers, like the 2, 3, on average? Would you say you're getting people still competing for it, or would you get maybe one offer today and then another offer maybe a month from now, something like that?
Certainly we're finding the smaller properties, and when I say smaller, I say anything under 30 units, you might get a trickle of offers, 1, 2, 3, not necessarily all at the same time, but anything over 30 units, there's still a significant demand, and so you'll often set a bid deadline and say, hey, this is when offers are due, and at that time you'll get the 3, 4, maybe 5 offers that are competing. Depending on who the buyer is, you may know right away who the most serious buyer is, because they're coming to the table with the right numbers that are in the interest of the seller. They've got the wherewithal to be able to handle the financing in today's rates. And some of the other offers are really looking for a steal of a deal, and so right away that that's not the buyer to be working with.
Right. That's really interesting, actually, that over 30 units, you're getting a lot of interest. It's kind of like developers right now. I mean, I don't have a lot of experience with developers, but my cousin works for a developer, and he's saying that they're like really actively looking for opportunities right now because, people are offloading. There's lots of opportunities to scoop things up for a good price. So
for sure,
I can imagine the companies that have a lot of money are in a really good, or not a lot of money, a lot of cash on hand are in a good position right now.
Yes. Yeah. Certainly the ones that have leveraged their resources well, they're still being very active in the marketplace. The ones that are a little bit more limited in cash, they just can't compete at that level, unfortunately. And so, they're missing out on some of those opportunities. But, when you see rates at, 4.5%, 5%, and the sellers' cap rates are expectations are at 3%, 3.5%. That's a negative spread, and so the buildings aren't really cash flowing. And so there's been sort of this difficult play of, buyers' expectations and sellers' expectations, finding somewhere in the middle, and it takes a little bit longer to find that resolution between the two.
Yeah.
But it's certainly still happening today.
Right. Let's talk a little bit about the challenges, because you kind of touched on it right now a little bit in terms of expectations from sellers. But what about when it comes to refinancing? Can you tell us what you've seen in the last little while?
Yeah, I can certainly talk about that, not only from some of my clients' perspectives and the refinancing that they've gone through, but also for ourselves with our own portfolio. In the last year, we've had 3 of our properties come due for refinancing, and so we had to navigate. All of a sudden your cash flow is going to be significantly lower because you're eating and absorbing these higher rates. Sometimes what you want to do is, you don't want to play that rate game of saying, if I wait a little longer, maybe I'm going to pay that interest only payment for a few months because rates are going to come down. Sometimes it's better to just reorganize how you're running that property to be able to absorb the rate as it is today, rather than hoping that the rate's going to work in your favor, 3 or 4 months down the road. So certainly we've seen with our 3 properties that refinanced, we jumped from rates that were around 2.5% to 3% up to 4.25%. And we've found ways to make that work in our buildings. Some of the ways we do that is, converting some of our excess space to income producing spaces in our building, whether that's additional units or renting out office spaces that was previously storage units, just to make sure that the cash flow is there to support the refinancing rates. We've also been going to bat for some of our clients. Some of them bought buildings during 2021 and put in short-term financing for 3 years, and then they came due right when the rates were at their peak. And so certainly allowing us to go out and search for the right rate for them, the right lender for them. We're tapped into the 4 or 5 major lenders that deal with apartment buildings in Ontario. And what we found is that, the spread that the lender would charge on top of the CMB rate, they've been a little bit more flexible, knowing that the rates are a bit of a pinch right now for owners. And so, sometimes they would, using 85 basis points as their spread, they're now coming down to 70 or 75 basis points, just to make it a little bit easier for their clients.
Yeah, well, obviously these are typically over 30 units, what you're describing, right?
Right.
So for like smaller properties, from my experience, because I have smaller ones than 30 units, but the spread is obviously higher on those, right? So I've even actually, I think I may have heard of some people getting a 50-point spread on some of their refinances. Yeah,
depending on the relationship you have with the lender, and the amount of volume you do with them, there is certainly some flexibility, and owners are essentially calling in favors and saying, hey, I need you to work with me on this. I'm going to be a long-term client of yours. I'm going to be refinancing again in 5 years' time. Let's work something out in the present to make it work for me.
Yeah. And can you give us a few examples of maybe like your own portfolio or the company's portfolio, and how you were able to maybe add units or convert storage spaces or create office space, that sort of thing, and kind of share some of the numbers of what that looked like?
Sure. Yeah. So we have one building in Burlington where there was sort of a pocket of space that was really not being used for anything. It was an awkward space behind the elevator shaft, and it was too small to really be used for tenant storage, but it was big enough that much similar to the room we're in here, big enough to convert it into an office space. And so there's a number of business owners that are looking for places to operate their business. They just need an office space. And so we would go in there and we would do the flooring, the walls, install the technology that's needed for them, and install a public side washroom somewhere in the same hallway. And so they have now a facility to operate their business out of at a much reduced rate than they would if they went out to get a commercial office space. And so that, each of those floors having one of those offices, they can rent out for, $600-700 a month. Now all of a sudden you've got, you're bringing in an extra $3,500 a month just by renting out that dead space behind the elevator.
Right. That's a really good idea.
Yeah.
35, that makes a big difference if you're looking at the value add by doing that.
Yeah.
And were those, do you have any other examples that you can share? Just for people listening, maybe they're going through something similar and they're looking for ways to add some cash flow.
So there was a building that we have in Toronto that had 3 garages, double garages on the ground floor. And it just happened that with this particular tenant profile at this building, many of the tenants did not drive. A lot of them took the bus or biked. And so we were able to get a clearance from the City of Toronto to reduce the parking spaces by eliminating those garages. And we turned those 3 garages into 1 bedroom and 2 bachelors. And so we now took that building from 37 units to 40 units, fully rented out.
Beautiful. And just to go back to that other example with the office space, was that already a mixed use building or was it 100% residential?
It was 100% residential, and so we had to do the proper channels going through the city to get approvals. And we found that it was a fairly easy process to do with the city. You find you run into more problems when you try to do it without getting the permissions and the permits and everything else. Whereas if you work with the city, sure, you're going to be paying the fees, but then you know that everything is done legally and you're not going to have any issues with them coming in later on and saying, nope, shut this room down. It's better to do the work up front, pay the fees up front, and know that you've got it operating properly.
Do you know if it would have been possible to turn that little space into like a little Airbnb unit or like a short-term rental?
We did think about doing that initially when we were first talking about the space. What we found is that the Airbnb would be sort of an extra level of headaches, if you will, in the sense that you're constantly having to re-rent it out, even though their platform does it for you. You've got the upkeep of the furniture and the furnishings. You got to have a cleaning staff going in there. Whereas if you're renting out an office space, they're essentially responsible for their own office space, and you don't have to have somebody from a staffing perspective checking in on the unit regularly.
Right. Is there a downside to converting the building from 100% residential to mixed use? Because I think it might impact your financing moving forward, stuff like that, right?
Yeah, so it certainly won't qualify for the same type of financing just on those units alone, but that wasn't really our concern. Our focus was on bringing up the cash flow of the building. When we go to refinance that property, even if we do go CMHC and they don't count the income from those units, we've got enough stability in the rest of the building that we know that we'll still be able to pull out funds if we needed.
Yep. Now, for the people or any situations you've come across where, like you said, maybe somebody purchased a building 3-4 years ago and they got short-term financing and their renewal was due, what have they been able to do, or what have you come across that have been some kind of workarounds or solutions to be able to, not sink and not get yourself into serious trouble?
Yeah, so, something that has happened quite a bit with some of our clients, and we've even done this on one of our properties, is buying down the mortgage rate. So if you've got cash flow from another property that, is flowing well and is not coming up for financing, to be able to take funds from there and pay down the mortgage a little bit. So now, let's say your balance was at $3 million and you pay down to 2.5. Now you're mortgaging the 2.5. It's going to end up protecting a little bit of that cash flow rather than taking out the full mortgage at $3 million.
And are you getting like you're refinancing the other building that's cash flowing to get that $500,000 out, or are you
or it's already cash that's on hand with the property?
Yeah, so you've got $500,000 in the bank in that property, you just kind of transfer it over to pay down the mortgage.
Yes.
Right.
We have some clients that they came to us and basically asked us to look at their entire portfolio and to analyze which buildings are the most cash flowing, and then they would take out loans on those ones to pay down. In one case with one client, they had a VTB first mortgage on one of their properties that came due right in the middle of the height of the interest rates, and they had to pay down that or renew it. And the vendor that had the mortgage was basically going to increase his rate from, I think it was at the time 4% up to 8%, which would have significantly changed the cash flow analysis. And so what we did is we looked at all 6 of their properties and said, this is the one here that could sustain the high rates that we're at today. So why don't you take out a loan there and use those funds to pay down that VTB mortgage? And now you're stable across the portfolio rather than individual buildings.
And so you guys also offer consulting services, is that right?
Organically, I would say, because we've been around for over 3 decades now, we're really invested with our clients. A lot of them have kind of grown their business around our brokerage and bought a number of properties through us. And so we find that a lot of our time is spent just, consulting and giving advice that we're happy to do, complimentary, because we have such a good established relationship. And we know that when the time comes for them to sell, they're going to come to us because they've trusted us all this time.
Right. And can you tell us a little bit about, I guess, the brokerage? It would be considered a brokerage, I assume. Yes. But the brokerage also invests. So is it kind of a fund at the same time?
Yeah. So in the early stages of Skyview, we were certainly, blessed to be able to start buying some properties over the years. And, when I joined the company almost 18 years ago now, we were around 300 units throughout the province. Then I got involved in being part of the acquisitions team as well as doing the sales. And we've just steadily grown over the years. We had our significant growth 3 years ago in 2021, where we passed 1,000 units and up to 1,200 units. So we gained 300 units in just over a year. And certainly that meant that we needed to take some time to stabilize it and get the right staffing in place. But it's been a great journey, and having our own portfolio of buildings also helps us on the brokerage side, because one feeds into the other. We've got, the staff there that are experts in every area of running these buildings, that, when a client comes to us with a question, if we don't necessarily know the direct answer, I can go down the hall to our property manager and say, what is the trade person we would use for this particular problem? Mm-hmm. They know exactly who to go to.
Right. So is this a family-run business?
It is, yeah.
It is.
It's always been a family-run, independent business, and we're only focused on our own properties. We don't do third-party management, but we've got an entire management wing in our office. Mm-hmm. That's exactly what they do.
How many people would you say work at your office?
In our office, we have, I would say, about 15 people between on the management side. And then we've obviously got our building staff as well. Most of our buildings have their own superintendent or resident manager.
And how many people would you say are on the analysis/consulting team?
On that side, that would be on the brokerage side, where they do a lot of the research. And I've got a team of 3 people that are dedicated to just that. And then on top of that, we have 3 agents, myself, Danny, and Pat, and we're the ones that also do the sales. I'm guessing
you've all been there a long time. I know you said 18 years, but
yes.
Yeah, everyone's been there for a while, I guess.
Yeah, I've been there 18 years. I believe Pat's been there 17. Danny obviously started the company 35 years ago, approximately. And we've had other agents come and go throughout the years, but we're the ones that have been around the longest. And
right.
Yeah.
Great. I want to touch on purchasing in today's market.
Right.
So what are you seeing when it comes to purchasing and the financing involved? Are you seeing a lot of VTBs now? Are you just going straight to CMHC? Are you doing a bridge loan and then stabilizing the building and refinancing it? Yeah,
so certainly we saw a lot of bridge loans in 2021, 2022, just because of the amount of activity in the market. People had to be competitive with their offers. There was a lot of people doing firm offers, which is something I never recommend. That's a dangerous game to play if you haven't really done your due diligence. But when you go in with a firm offer, and a quick closing, that bridge loan would help them kind of get to the finish line until they can get their formal financing in place. We're not seeing that as much now. What we are seeing is a resurgence back to conservative due diligence periods and financing conditions periods, 30, 40 days to make sure that if you're going
30, 40 days only?
30 to 40 business days, I should say.
Okay. Yeah. I mean, even that seems like if you're talking about a 50 unit building or something, that doesn't seem like a lot of time.
Yeah, you can, from the inspection side of things, from the due diligence side of things, you can actually shorten that up. We can typically analyze a building and have our engineers look at it all within the first 20 business days.
Yeah.
Financing is the one that it takes longer, and so that's where you'll get up to the 40 business days. CMHC, credit to them, they've really tightened up their process. There was a time where it was taking 10 to 12 weeks to get an approval. And so that would certainly slow down the sales process.
It was more than that, I think.
It could be, yeah.
Yeah, like I remember there were times where it was taking, I think, 6 to 8 months.
In some properties, it could be that case.
Yeah.
We found 12
maybe not on a purchase, though. Maybe on a refinance. I'm not sure if there was a difference there.
There is, yes.
Yeah.
So they have for years prioritized purchases.
Yeah.
Whereas refinancing, because they've already got all the details, they kind of take their time with that one. But yeah, 12 weeks we find was sort of the standard. They've now got that down to about 8 to 10 weeks, so they're improving there, and that's certainly helping with the financing process. But obviously, rates are not back to where they were in the heydays when people were getting 2.5%.
Yep.
So it means that often a buyer is having to put a lot more down to cover the difference, because they're only going to lend you what is going to be carried by the property. Certainly these days, it used to be with CMHC that they would apply a cap rate to whatever market you were buying in, and then based on that building value that they would come up with, they would lend you 85% of that value. Now the more important factor is the debt service ratio. What can the building sustain from a mortgage perspective? And so, if it used to be that a buyer was coming in with 30% down, now they're probably coming in with 40 to 50% down, just because of the amount that the mortgage would carry. And so certainly VTBs are a big factor in today's market. Being able to have an extra 20% of the purchase price on a VTB at a low rate allows a buyer to still come in with a relatively good down payment, but have the cash flow still there on the building.
Are you talking about a VTB in second position?
Yes.
Okay. Can you give us some examples of what you've seen recently in terms of those VTBs?
Yeah. So, it used to be that the VTB was just, 10, 15% of the purchase price, really just to kind of get over that hump of the financing. We are seeing that increase now more to 20 to 25% when it's in a second position. And often what's negotiated is a very low rate on that VTB. I did one a few months ago where that rate was 1.5% interest only. It was really just to facilitate the sale. It wasn't a moneymaker for the seller by any means. But the reason it was so low is that when you blend the mortgage rates between what they're getting on their first mortgage and what they're paying on the vendor take-back mortgage, the averaged out rate still keeps it below the cap rate that they're purchasing, so there's still a profit spread there.
Have you seen or heard of any situations where maybe somebody gets a really good first position VTB, and then like in those situations where it's due for renewal and the rate's significantly higher than the VTB, where somebody might convert that the seller might convert that first to a smaller second, just to make the deal work?
Yeah, so there's been a couple of cases with clients that I was dealing with where they bought a property with a VTB first position, and it came due right at this time. In one case, we were able to go to the vendor that held that mortgage, pay down a portion of it, so they were able to pay down some of the balance, so he had some cash flow coming back at that time, and then negotiated an extension to that term. So he initially had a 3-year term, and it was at 4%. They then paid down half of that balance from the refinancing of another property, and the rate went up to 5% interest only for the next 2 years. So they had an extension on the VTB, a little bit higher rate, but because it was interest only, it was still protecting that cash flow.
Yep. Can we talk a little bit about what the strategies are when you first take over a building? Let's call it like a 40 or 50 unit building. I'm sure you guys have systems in place. What are the first things that you do when you take possession?
Very first thing we do when we take over a property is look at the staffing. The 9 times out of 10, the resident manager or superintendent that's already there, they're going to stay on board. They already know the tenants, they know the building. So it's really about bringing them into the fold, getting them to understand our systems, our expectations, training them with the way that we do things, and making sure that the building is stable because the staffing is stable. Very rarely do we go in there and say, oh, this person's not going to work and we have to find somebody new. But it does happen. And so it's always the first step is to make sure that the staffing is in place. And then we look at things that came up during the due diligence period. So when we're in our conditional period, we're looking at what are the value add opportunities at the property, and we're doing all our analysis before we even go firm on a property, so that once we know we're purchasing this property and we know it's closing, we're ready to hit the ground running with some of those value add opportunities. So in some cases, it's just purely the upside in rents. Other times, it's conversion of space. Other times it's dealing with the utilities. You might find that the hydro is way out of whack on some of the units. So we might bring in a wise meter and install sub-metering and start to roll the tenants over as new tenants coming in to paying their own hydro. So we'll hit the ground running with a number of these projects to make sure that the building is going to cash flow and profit the way we want it to.
Right. When you mentioned supers and keeping them on the project or in the building, in the situation where you do need to replace a super, what is the process for that?
Certainly, we can identify that during the conditional period. You know right away whether this is going to be somebody that's going to be a team player for you or not. Just the way that they work with you when you're doing your building inspections, and you can see how they interact with tenants. You can certainly get feedback from the tenants themselves. When you do these apartment inspections during a due diligence period, tenants love to talk, and they talk about the troubles they're seeing.
Oh, everything.
And you'll know if it's a bad resident manager because there'll be, hey, I put maintenance requests in all the time and they never come around. So you start to get a sense of what's happening at the building. In terms of if we do need to hire somebody, we'll post an ad, whether that's on Indeed or any other job listing site, and we've got criteria that we look for. Even right now, we're looking at hiring for one of our buildings where somebody is retired, and so I'm involved in setting up the profile of who we're looking for that particular property, and bringing in resumes and screening people. But we like to take our time. It's important to find the right person because they're going to be the front-facing person for the company. So you don't just take anybody that applies. You really do your analysis and make sure that it's going to be the right fit.
And do you typically allow them to get a discounted rent if obviously they're likely going to be living in the building,
right?
Or are you giving them free rent? How do you structure that part?
Typically, we give them free rent. So whatever the market value of their unit is, that's part of their compensation, is they get that unit compensated for them. And then there's usually a salary component above that as well.
Okay. And that way, that gives you the flexibility. Let's say you hired the wrong person, things are not going well, you can terminate the agreement and then get the unit back, right?
Yes. I believe the rule right now is if they're just an employee and not a tenant, you can give them 2 weeks notice, just like any employee. And that's part of the reason why we take our time really screening the applicants. You don't want to do that to somebody. You don't want to bring them in, move them in. They've now got their apartment set up, and then it doesn't work, and now they've got to be out in 2 weeks.
Yeah.
The unfortunate thing is you need some staffing there, so you need to replace them, but you don't want to put somebody out after 2 weeks. And so it really comes down to screening somebody ahead of time. Yeah,
of course. Let's touch on power of sales.
Sure.
What are you seeing now when it comes to power of sales and apartment buildings?
Yeah, so I would say about 2 years ago, we were sort of bracing ourselves, thinking that we were going to see a lot more power sales happening. What happened in 2020 and 2021, a number of people came into the marketplace buying these properties that didn't really understand sort of the long-term effects of owning these types of properties. And so they were buying, and we were watching these transactions happening. They were buying with almost no leverage whatsoever, coming in with 5% down, and maybe they got a mortgage for 75% of the purchase price, but then they would go and they would get a second mortgage from a private lender for another 20%. So they're really only coming in with 5%. And then those loans started to come due. They were doing 3-year terms instead of 5 or 10-year, not knowing that the rates were going to be where they were. And so we started to see some faltering out there and power of sales coming to.
So sorry, just to clarify, are you talking about like these are 40, 50 unit buildings, or you're talking about like $7-8 million purchases?
Yeah. So I'm familiar with one in Durham region that we dealt with. I think it was 35 units. Mm-hmm. That was a power sale that came to us when they started to fail, and they had basically almost leveraged 100% of the property between their CMHC financing and their private lending. Yep. And that private lending, they were paying 10 or 12%. So there was no cash flow, and it was no surprise that they eventually lost that property. Mm-hmm. We were expecting to see a lot more of that. Thankfully, our industry is very resilient, and people found ways to adjust and kind of fix those mistakes. But there's certainly more power of sales happening through us over the last 2 years than we're typically have been doing. We've got 4 lenders that use us exclusively whenever they have a power of sale, and that in previous years that might have happened. One would come to us every couple of years, whereas now we've dealt with 4 of them in the last year alone. So there is an increase, but not a panicking kind of increase.
Right. Yeah. But that's still a pretty substantial amount. You said four of them in the last 2 years. Did you say?
Last year.
In the last year.
Yeah.
4 buildings went under, but that's actually surprising to know that people were buying these larger buildings and being 100% like leveraged on it.
Right.
But I don't really understand. Do you have any idea what the strategy might have been? Like, how do you borrow that much and then what's your exit strategy?
Yeah, I can't really speak for the mindset of the owners in those cases. Mm-hmm. We were obviously representing the lender, and they're just trying to recoup what they've put in on the property. But from what I understand is, some people were trying to grow really fast in a really hot market. And so rather than putting all their eggs in one basket, they were trying to take out as much funds as they could on each building to be able to buy a number of buildings at once. And for some people that strategy worked, and unfortunately for some it didn't. And we're always a big proponent of the idea that, hey, you don't want to be over or under leveraged. Mm-hmm. You want to be just right. And you want to make sure that you've got some skin in the game, and especially if we're dealing with a seller and he's providing a vendor take back, you want to make sure that the buyer has got skin in the game there, rather than just trying to over leverage everything.
What do you think would be a good loan to value, like to be on the safe side from what you've experienced?
I think a healthy loan to value is around 75%. Mm-hmm. A great deal for a buyer is when they can get it down to 20 to 15 to 20% down payment is great, because it makes your return on investment look really good. But I think a healthy leverage is around 25% of the purchase price.
Yep.
You've got some room there in case there's any problems. The unfortunate thing is that, to buy a property with just 25% down in today's interest rate market is not necessarily as realistic, especially in some of the larger markets throughout Ontario. I think it's still feasible to happen in some of the small tertiary markets, but places like Toronto, just the expectations on pricing, you're going to be paying 40% down unless you end up getting a VTE in second place.
And are you seeing that more where people are putting a larger down payment just to make things work?
Yes. Yeah, certainly, people want to be able to go in with as little down as possible, obviously, but realistically, if you're in the market to buy and you're buying in a stabilized market, like whether it's Toronto, Hamilton, Oshawa, realistically, you're looking at 40%.
Yeah. Can we touch a little bit on transaction volumes? Yeah. What are you seeing with that?
Certainly, there has been a cooling off in terms of number of listings active in the market. There's still opportunities out there. There's still portfolios that are being sold. There's still buildings throughout the province that are coming to market, but it is significantly slower. And that's sort of part of the roller coaster ride of sales in multi-residential. I've seen it certainly in 3 phases in the 18 years that I've been here, where the transaction volumes slow and then they rise back up again. There was one report that came out a few months ago. One of the national real estate brokerages did an apartment industry update, and they said that transaction volumes were down about 70% from where they were 3 years ago. Mm-hmm. So there's certainly a lot less activity, but our industry is so strong. I've seen it go through this many times now, and it always bounces back. It's just sort of a nature of where we're at with the interest rate market. Similar to what we saw in 2020 when lockdowns came into place and everybody stopped transacting for a while. We're sort of in that stage right now where rates are starting to come down, and so volume is starting to pick up. There's that ebb and flow. Mm-hmm.
Yeah, what do you predict will happen? I know like nobody knows the answer, but just getting your opinion. Yeah. Moving forward in the next 2-3 years, what do you see happening with transaction volumes, with just the economy, and with the apartment building industry in general?
Yeah, I think 2025 is going to be a significant year. Obviously, I like you said, I don't have a crystal ball to know for sure, but I think we are seeing the interest rates have started to come down. In the last 6 months, they've gone from being at, for CMHC financing at around 5.25. Now they're down to, I think today's rate was at 4.06 if you mm-hmm. were to lock in today, and it had even dipped below 4% as of last week. I think we're not going to see the return to what we saw 3 or 4 years ago, where rates were dropping even below 2%. That's not a healthy rate mm-hmm. for the economy itself. I think what we're going to find is it's going to sort of normalize to between 3.5% to 4%, and that'll become the standard for the next little while.
I had somebody on the podcast a little while ago. He said he locked in a 10-year rate at like 1.88%.
Yeah.
Did you guys do anything like that?
We had a couple of properties like that we refinanced in 2020 and 2021, and when we saw what the rates were, we locked in for 10 years.
Yeah. It makes sense, right? That's the thing that we were hearing a lot about on the residential side before. I know that's not really your thing, but a lot of people were talking about the BRRRR strategy and doing something, refinancing it and getting 100% of your money out and then moving on. And then a lot of people wanted the flexibility, so they were doing variable rates. Yeah. But when you're talking about a larger property, most of the time people are doing this long term. So yes, you're happy to lock in for 10 years if you're getting an amazing rate. You might not ever get that rate again.
Yeah, absolutely. Yeah. The majority of people in the apartment building sector use fixed rates. I know that there were some that came into the market a few years ago that were also using variable rates, and they got bruised pretty badly on that. Yep. But the majority of people usually lock in for 5 or 10-year rate.
Yeah, exactly. Any final thoughts?
Despite the fact that we've talked about a cooling market and the trouble with interest rates, I still have a lot of optimism around our industry. There's some great people. These buildings have always, stood the test of time. And with prudent operators, there's ways to make sure that profit continues. So looking forward, I think, we're always going to see a bounce back of the apartment industry, and it's a great place to be a part of.
Mm-hmm. Great. I appreciate you sharing all this and bringing your knowledge and experience and expertise. And thank you for your time, and we'll be in touch.
I appreciate it. Thank you.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember, our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.